What if I told you that you could legally reduce your 2025 tax bill by up to $2,400 just by moving some money into a specific type of account? And what if I also told you that most people will completely miss this opportunity because they don't know about a simple age-based rule that could unlock an extra $1,000 in contributions? Hey everyone, my name is Grant, and if you're serious about building wealth and keeping more of your hard-earned money away from the IRS, then you need to pay attention to what I'm about to share. The 2025 IRA contribution limits are here, and there's a lot more to this story than just the numbers everyone's talking about. So let's start with the headline number everyone's buzzing about, $8,000. But here's what's interesting. This isn't actually the limit for everyone. The standard IRA contribution limit for 2025 is $7,000, but if you're 50 or older, you get what's called a catch-up contribution that bumps you up to $8,000. Think about it this way. If you're in the 30% tax bracket and you max out that $8,000 contribution, you just saved yourself $2,400 in taxes. That's like getting a $2,400 discount on your retirement savings. Not bad, right? Now, here's where it gets tricky, and this is the part that trips up a lot of people. Just because you can contribute doesn't mean you can deduct it from your taxes. And that tax deduction? That's the whole point of a traditional IRA. The IRS has these income limits that determine whether you get the full deduction, a partial deduction, or no deduction at all. And these numbers might surprise you. If you're single and you make $79,000 or less, congratulations, you get the full tax deduction on your IRA contribution. But once you cross that $79,000 threshold, your deduction starts to phase out. Hit $89,000 in income, you lose the deduction entirely. For married couples filing jointly, you're looking at $126,000 for the full deduction, with a complete phase-out at $146,000. But here's something really interesting. These limits only apply if you have a retirement plan at work, like a 401k. If you don't have a workplace plan, you can deduct your full IRA contribution regardless of your income level. Here's a little-known strategy that could double your retirement savings potential. If you're married and one spouse doesn't work, you can still open what's called a spousal IRA for the non-working spouse. This means you could potentially contribute $14,000 total as a couple under 50 or $16,000 if you're both over 50. The key requirement? The working spouse needs to earn at least enough to cover both contributions. So if you want to max out both accounts and you're both under 50, you need at least $14,000 in earned income between you. Here's something most people don't realize. You don't have to make your 2025 IRA contribution in 2025. You have until tax day 2026 to make your 2025 contribution. This gives you incredible flexibility. Let's say it's March 2026 and you're doing your taxes. You realize you're going to owe more than expected. You could make a 2025 IRA contribution right then and there and immediately reduce your tax bill. It's like having a time machine for your taxes. Instead of trying to time the market with one lump sum, consider setting up automatic monthly contributions. If you want to max out at $7,000 for the year, that's about $583 per month. This approach, called dollar cost averaging, helps smooth out market volatility and makes the contribution more manageable for your budget. The biggest mistake I see people make is thinking they can't contribute to an IRA because they have a 401k at work. That's completely wrong. You can absolutely contribute to both, though the IRA deduction limits I mentioned earlier do apply if you have that workplace plan. Another huge mistake? Not contributing because you can't afford the maximum. Even if you can only contribute $100 a month, that's $1,200 a year growing tax-deferred. Over 30 years, assuming a 7% return, that turns into about $110,000. Not maxing out is not a reason to not start. So here's what I want you to do right now. First, figure out if you're eligible for the full deduction based on your income and whether you have a workplace retirement plan. Second, if you can't contribute, set up that automatic transfer today. Don't wait until December and stress about finding $7,000 all at once. And if you found this valuable, smash that like button and subscribe for more tax and investing strategies that actually work. I drop new videos every Tuesday and Friday, and trust me, you don't want to miss what's coming next. Remember, the best time to start investing was yesterday. The second best time is right now. I'm Grant, and I'll see you in the next video where we're going to talk about the Roth IRA income limits for 2025 and a backdoor strategy that high earners need to know about.